So I'm a huge fan of dividend investing, but you probably already knew that. But it's not perfect. So in this video, let's look at some of the downsides of dividend investing. Let's get the most obvious one out first, and that is that dividends are taxed. With other ways of investing that don't involve dividends, you're usually investing for the price growth over time. So the only time that you're taxed is if you sell. But with dividends, every time you receive the dividend, and that's if you receive it as cash or even if you reinvest the dividends, it's treated as income and you're taxed on that income. Now, how much tax you pay is based on your personal tax rate. In Australia, we do have some advantages over international stocks because most Australian companies have some sort of franking on them. What that means is that the company tax has already been paid on most companies, but not all. So if you see that the dividends are fully franked, that means 100% of the company tax has been paid. Partially franked means that some of the tax has been paid. If they're not franked at all, then none of the company tax has been paid. Now, the company tax rate is 30%. So depending on your personal tax rate, if your personal tax rate is above 30%, you only pay the portion above 30%. And if your tax rate is below 30%, you might even get a refund based on what you don't have to pay. Now, there can be advantages of that using the franking system if your income is low. But overall, yeah, you're taxed on the income from dividends. Now, the second drawback is that your income is not guaranteed. Sometimes I like to think of the dividend yield as like a savings rate you would get on a high interest account. So when you put your money into a stock, the dividend income that you get is kind of like the interest, but not really. For starters, the dividend amount that you can get from some companies is going to vary widely. It's not consistent and it's not guaranteed. I try and minimize this as much as I can by looking at the dividend consistency in the past to see how much the company has paid in the past, to see if they're paying both at a regular interval, a regular time frame, and regular amounts, but there's no guarantee that you're going to get the expected dividend payment. Now, we saw this during the pandemic when a lot of companies either delayed or even cut the dividend altogether to try and hold on to their cash flow. But there doesn't need to even be a pandemic. It could happen at any time. The company could just decide it would rather hold on to the cash or use it for something else rather than pay investors. And if you're investing for the dividend, that can suck. The only real way to avoid this, and you really can't avoid it altogether, is just to look at the history of the company, make sure that the company has been consistent in the past. The third downfall is those high initial dividends that some companies use to try and attract investors, but then once they have those investors, they'll drop the dividend and it's no longer a high dividend company. Sometimes things can be too good to be true, and that's true of those ultra high seductive dividend yields. This often happens with new companies, especially when they're trying to attract investors, but it can happen to established companies as well. I'm not talking about special dividends, those one-off dividends that companies pay at any time. I'm talking about the regular, interim and final dividends that they're offering investors that are higher than normal. It's kind of like the honeymoon interest rate on a savings account, that they're just doing it to attract new customers, or in this case, new investors. But that high yield is likely to be temporary and unsustainable. And if you're aware of what they're doing, you can actually take advantage of it and then move on. But yes, don't be seduced by those high dividend yields. Always make sure that the company has been consistent in the past. And following on for this, number 4, the yield that looks high because the stock price has fallen. This time it's not because the company is trying to attract investors. The yield just looks inflated because the stock price has fallen, and the calculation for yield is based on the last 12 months of dividend payments and the current stock price. The main issue here is, why has the price fallen? Is it just the overall market conditions, or is there something going on with that specific company? And while this is not so much of a downside as it is just something to be aware of, you really need to just investigate why that dividend yield is so high. And number 5, and probably the one that I find the most, is that if you're relying on the dividend income, it can be inconsistent. Now, this is going to mostly apply to people that either rely on part of their dividend income or all of their dividend income to pay their bills and fund their lifestyle, like me. So companies in Australia usually pay dividends twice a year. ETFs usually pay 4 times a year. But those months can vary from company to company. It is possible to have income coming in every single month, and I have curated my portfolio in the past to have that happen. But even so, some months are going to be way higher than other months. For me, March and September are my highest months. That's where I get the bulk of my money. And currently, I don't get anything in June because the company that used to pay in June, I no longer hold. So my income isn't consistent month to month like it would be if I was getting a paycheck. Some months it's really, really good, and some months it's not great. So to overcome this, you really have to be good at budgeting your money and managing your money. So the months where you're getting a lot of dividends, you need to save a lot of that money to cover those months where you're not getting as much dividends. So income can be really inconsistent, especially if you're relying on it. If you're not relying on it, or if you're just reinvesting, it's probably not as much of a deal. But yeah, for those of us who do rely on that income, it can be a bit of a downfall. So with all these downsides, do I still think that dividend investing is a great way to invest? Everyone's goals and strategies is going to be different. I've always said that there's many ways to make money in the stock market and there's many ways to make money outside the stock market, but I am sticking to dividends. Anyway, take care. I hope you've enjoyed this video and I'll see you in the next one. Bye.